welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches in sunny Northern Beaches of Sydney, and we also go right out around Australia on the Community Radio Network, complements of the Community Broadcasting Association of Australia. We also go out on iHeartRadio, Spotify, and YouTube, and also our blog, and also IFPA blog, because we're part of their continuous learning program, and we do constant financial education, which is what we are all about. And talking about IFPA, it's wonderful to welcome back Natasha Panagis, who is a subject matter expert on superannuation and amongst other topics at the Institute. Welcome back, Natasha.
Thanks, Ray. Thanks for having me back on the show.
Well, I got to say, 2 years ago, when this was announced that the finance industry was in a tether, and I said even back then, it's going to change. There's absolutely no way known with this government under any guise go forward with taxing unrealised gains and all the malarkey that went around Div 296. And guess what happened just recently? And that's what today's show is all about, is we're going to be talking about the changes in Div 296. So with that in mind, Natasha, we've covered a lot of territory in this space over the last couple of years, haven't we?
Sure have. It's been a very popular topic. Everyone's talking about it. Not just, it started off in the industry, right? People in the industry were talking about it, and then slowly everybody else started to learn about it. And then in the last year or so, it was in mainstream press, on the telly, on the radio, in every article. So I think it's something that has been worthwhile pushing forward with, and just making everyone aware of all the issues with how it was originally proposed to work.
I guess what fascinates me is about 18 months ago, I was at an industry conference in Canberra for the AIOFP, the Association of Independently Owned Financial Professionals, or whatever that. Blah, blah, blah. Anyway, Wayne Swan was the keynote speaker, who is the head of, or the Labor Party at that time, ex-treasurer, used to be at one time the world's best treasurer, and he was up there vociferously defending this, going, well, the other side would do it. And I got to say, even if I am slightly left-leaning, me and a whole bunch of other people just sat there and went, this is garbage. The whole notion of taxing unrealised gains just created this nightmare. And I know, Natasha, you and your team of experts at IFPA went to Canberra and spoke to a lot of politicians about this, didn't you?
Yeah, we did. And we also put forward many submissions, handful of submissions. We were involved in the Treasury Roundtable behind the scenes. We, went to the Senate Economic Legislative Committee public hearing, which was looking into the bill, and we raised all the issues along with it. So we've certainly been advocating against this measure as proposed, as it was originally proposed, and just raising all the issues and then the changes that would be needed to make it a more fair and equitable tax if we were to have it in the system.
So look, today what we're going to do is we're going to cover off these changes, but I guess overall you've had a change of leadership at the association, and I'm really pleased for Kai, who's the new CEO of the Institute. And I guess with the general direction of being a group that is out there advocating for the industry, were you surprised, or were you more relieved, and was this something that you saw coming?
Yeah, look, the general mood, if you say, within the Institute of Financial Professionals Australia, IFPA, we are ecstatic. We're really happy with the government's decision to make those key amendments to the controversial Div 296 tax proposal. If you asked me earlier this year, is this going to get the go-ahead, I would have said yes.
Really?
We did. Everybody thought it was going to get legislated earlier this year, but before the election, but post the election, with all the pressure that has been put on the government, we started to see signs which really pointed to the fact that they had to think about making changes to this measure. So we're really happy that the government has actually listened to all of the issues that have been put forward. Under the revised plan now, the government's going to drop the idea of taxing unrealised gains, and it's going to introduce indexation for this Division 296 threshold, which is these two key changes were two key things that IFPA has been advocating for from the beginning. So we've said that this is a win for common sense. Taxing unrealised gains would not only have been complicated, but it'd be inherently unfair, out of step with basic tax principles. And now, you'll have members that will only pay tax on income or gains that they've actually realised, actually received, not on any paper profits or any market movements that their fund, their balance has seen from one financial year to the other. So we're talking about actual income, actual earnings. The other thing we're really happy about is this decision to index the threshold. This will make sure that the system keeps pace with inflation, wage growth, and the rising living costs that we're all seeing at the moment. And the last thing we're really happy about is the delayed start date. So this was all meant to kick off on 1 July 2025, but this has been deferred for a year to 1 July 2026. And we think this is a sensible step. It just gives everybody involved with Treasury, super funds, and the industry a lot more time to refine the details, get the implementation right. And yeah, we're just looking forward to working closely with the government and other key stakeholders to make sure that we've got a system that is fair, practicable, and also sustainable for all members involved.
I've got to say, look, I get a ton of daily emails into my inbox, which I try and flick read, but certainly the FAAA, the Financial Advisors Association, whatever the FPA is called these days, AOFP, the SMSF Association, all the different SMSF representative bodies out there, all roundly applauded, and still dished out a fair bit of dirt on the government, because I think at the end of the day, we go back 2 years and go, why did you guys even concoct this cockamamie policy? Because from my perspective, if you just look at the pure politics of it, there was just no gain anywhere you could go. It was all this pain for absolutely no benefit. And there are much better ways of making the tax system fairer and being able to, I guess an element of fairness. And the ALP has always gone out there and talked about fairness. And you'd have to sit there, any pub test you look at this and scratch your head and go, this just doesn't make sense. And so one of the things I wanted to talk to you today, Natasha, is let's go over some of these key changes in some of the details so that our listeners and viewers can get a bit of an idea, because beforehand it was a little complex. Now, am I right in saying it's got rid of some of this complexity?
Yeah, I think that's a fair statement. So what are the key changes? Well, now under this new revised proposed approach, we're only looking at real earnings that are going to be taxed. So no more tax on any unrealised gains. So you'll only pay tax on income, earnings that you've actually made within your fund, which is good, which is great, I should say. So that's the number one main change. Secondly, the super funds are going to work out what the members' real earnings are going to be, and they're going to report that to the ATO. So, whether you have your own SMSF or part of a large APRA fund, the fund is going to work that out and report those actual earnings to the ATO. And then we've got this $3 million threshold. So this is the Division 296 threshold, the Div 296 threshold. This is going to be indexed to inflation, and it's going to increase in $150,000 increments. So this will keep pace with rising costs as we see them. But the interesting thing is they've now introduced a second threshold, a new $10 million threshold. All along, we've just been talking about a $3 million Div 296 threshold, but now we've got a $3 million threshold and a $10 million threshold. So this is newly introduced. And so any earnings above that threshold, the $10 million threshold, will be taxed at a higher rate of a total 40% tax rate. And that threshold will also rise with inflation. As I mentioned, this will all kick off on 1 July 2026, which gives everyone a bit more time to prepare. And there are plans for defined benefit pensions to also be included in this regime. And that's to make sure that, all super funds are treated the same. So in a nutshell, they are the key changes that have been announced and what we know so far.
And so just ladies and gentlemen, if you are trying to do the maths in your head, I'll shortcut it. But in effect, the indexation will be stepped up in 5% increments. So from the original number, so 3 million at 150K is 5%, and 500,000 at 10 million cap is 5% as well. I guess it remains to be seen, because as the cap then goes up, that percentage decreases if you love mathematics, and I do. But anyway, I think I'm polishing something there that I'm not going to go into in further detail. Anyway, let's talk a little bit about administration. So the super funds will continue reporting the numbers and the balances to the ATO. And so I guess this now comes around what's going to be determined as realised earnings juxtaposed to unrealised. So what counts as a realised earning?
Yeah, so look, the Treasury fact sheet that was provided along with the Treasurer's media release statement doesn't define realised earnings precisely. What it does say is that, and what we're expecting is that it's going to be based on a fund's taxable income. So I think these includes things like any interest, any dividends, any distributions from managed funds that the fund might have, any rent if there's a property in the fund, and any capital gains as well that have been generated within the fund. So actual income, actual earnings. And in the fact sheet, it says that there will be some adjustments made to this taxable income. It'll be adjusted for any contributions that go into the fund and any pension income that might be paid out of the fund as well. So you might be in pension phase, and that will be factored in as well. So in other words, the idea is that realised earnings is going to be very closely aligned to how taxable income is already calculated today. And then these super funds will work out each affected member's share of those realised earnings using existing reporting processes, which is quite easy for SMSFs, because you can work that out using the fund's tax return. Or potentially another method they can work it out that is considered fair and reasonable. And this will mean that funds may not have to work out the exact earnings for every member, which would make things simpler, particularly for large super funds. But we're expecting some more further guidance from the ATO to confirm the finer details.
Excellent. Well, look, we're about half time. You're here on Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone today Natasha Panagis, who is a subject matter expert on superannuation from the Institute of Financial Professionals of Australia. We're going to take a short break, and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense. I'm your host, Ray Treverson, and at the microphone today we have Natasha Panagis from the Institute of Financial Professionals of Australia. And today we are talking about Div 296 and the wonderful news that the ALP relented and changed this ridiculous policy of taxing unrealised gains, and a few other changes that we are actually talking about in today's show, Natasha. Now, before we went to the break, we were talking about realised versus unrealised gains and what that actually means. Now, one of the big things, and I know one of your colleagues, Stuart Sheary, and I were talking about this as well, is people that have big chunky lumps of investment sitting in their super fund. And I'm now going to talk specifically to our regional listeners, and I'm talking specifically about farmers who, rightly or wrongly, put their farms into super. Not really the purpose of what it was for, but we are there. And so they were running around like headless chooks going, what are we going to do now if we get taxed on the capital appreciation of our farms? That's now gone away, hasn't it?
It has now, yeah. So we're not taxing. The idea is not to tax unrealised earnings, but to tax actual realised earnings. So, as we just spoke about, these are things like interest, dividends, rent, actual capital gains, real tangible income and earnings, and not paper profits or paper earnings that a fund has potentially got from one financial year to another. So, which is a great change from the government.
That also means, again, for anybody that's out there investing in the stock market, and I know many people in super do, and so this also means that if the stocks that you buy go up, you're not going to be paying tax year on year for any of the gains that occur in those shares. That's correct as well, isn't it, Natasha?
Yeah, I mean, under the previous proposal, it was all based on your total super balance and how much it has grown from one financial year to another. So, you could have had assets within your fund that have done really well from one financial year to another. And even though you may have not actually, received that income or sold those shares or those assets, you would technically still be up for Division 296. But now, because it's actually based on real earnings, that has now fallen away, and we are just expecting this new proposal to be based on actual taxable income. But again, we just have to wait to see what the details are. We know that the government is going to release some more information, draft legislation on this early 2026. And I think that's where all the devil will be in the detail there, because we're still waiting on a confirmation of a couple of things in terms of how, what does taxable income actually mean? And there's some things that we'd like to get clarified along the way.
You stole my thunder. I was going to quote Paul Keating, the devil is in the detail, but you got it before I could jump in. So thank you for that. So look, let's cover off now, if you've got this liability of potential earned revenues that have actually come in, how is this calculated?
Yeah, so there's a 5-step process that will be looked at, and in terms of how to calculate the Division 296 liability. And so, first of all, the process is that the ATO is going to notify the super fund that there is a member that is going to be impacted by Division 296. So, and that's because the ATO has visibility of what your total super balance is and will know whether you're in or out of Div 296. And so then the fund is then your super fund is then responsible for calculating your realised earnings that's attributable to that member. And they're going to need to report that to the ATO. So that's step 2. Step 3, the ATO is going to calculate, your level of Division 296. Depending on your thresholds, and then work out what your end liability is. So that's it in a nutshell. But for example, let's just say you have a total super balance of $4.5 million. Okay, so let's just say it's $4.5 million, and let's just say your super fund actually made real earnings of $300,000 in that financial year. So when you put it through the calculations, the proportion of your $4.5 million super balance above the $3 million threshold works out to be about 33.3%. And then once you plug that in to the formula, it works out that your Division 296 tax will be about $15,000. And that's effectively your standard 15% tax rate times by your earnings of $300,000 times by the proportion of 33.33%. So as you can see, only a proportion of your earnings over that threshold will be taxed at the extra 15%.
So the sky's not falling in, is it? It's not taxed at the entire amount. It's proportional, and so at the end of the day, when you look at it, I guess, again, I use that common term in the media, the pub test. It doesn't sound as onerous as people have been making it out and screaming in the streets going, the world's going to end. It's not, is it?
Well, no, they have simplified it. So if you think about this whole new Div 296 measure, really what it's doing is introducing a 3-tier multi-tax environment to super if it gets implemented. So really, if you've got a super balance up to $3 million, you just pay the standard 15% tax rate. Okay, so you just pay the normal 15% tax rate. If you've got a balance between 3 million and 10 million, then you're going to pay an overall tax rate of 30%. So how that's worked out is your normal 15% plus the additional 15%, additional Div 296, 15% tax rate on a proportion of your earnings. And if you've got over $10 million, then your overall tax rate is 40%. And how that is worked out is your standard 15% plus the additional 15% Div 296 tax rate. And then you get hit with another 10% tax for having a balance of over $10 million. So really a 3-tier tax system depending on your super balance. So basically the more you have in super, the higher the tax rate on your earnings above those thresholds, if that makes sense.
Oh, it makes perfect sense. And look, no, seriously, what we're talking about here is no different to the I guess the incremental tax scales that we have in PAYG, pay as you go, when you've got income, the more you make, the more you pay at the upper ends. You don't pay that rate on every dollar that you earn. And in the same way, they've scaled this in the super balances as well. I wanted to as well bring a little bit of reality to discussion when people were, again, the hyperbolic discussions that were going around in some right-wing media factions. I just got a little cranky because I did a search today, and according to Google AI, how reliable is that? I don't know, but only 8,000 Australian superannuation accounts have balances over $10 million. That, according to the total figure of 24.7 million super accounts across Australia, equals 0.03%. So the number of people that are impacted, I'm just sitting there going, wow, are we really going to gnash teeth over this kind of thing when the vast majority of people that are sitting at those levels of income have got darn good chartered accountants who know how to work the numbers? Natasha, is there too much hyperbole around this, given that you've just explained to the audience they're only paying a fraction of what people were thinking they were going to be paying?
Yeah, look, some good points there, Ray. If this gets introduced, yes, we're bringing in 3 different levels, which is kind of does seem a little unnecessarily complicated. Maybe they could have just done away with the $10 million threshold and kept it, under 3 mil and over 3 mil. I don't know. This did catch us by surprise, to be honest, introducing this new threshold.
Oh.
But if you think about it, depending on how you count them, there are now around 20 different tax rates that can apply to super funds or individual members. So, while some complexity is understandable given the generous tax concessions that super provides, the system has become extremely difficult for individuals to manage on their own. And I reckon this was likely never the intention. All these changes that have happened to super over the years have caused this. So, we see very few people handle their own super accounts these days because the rules are so complex and they just keep getting more complex along the way. And the real risk is misunderstanding these tax rates can have some serious consequences. You make one mistake, that can then trigger taxes along, a number of different taxes along the way. So, yes, there's a lot of taxes within super. In terms of the media commentary that's going on at the moment, I'm not too sure. Yes, large balances only are quite rare. They only make up less than 2% of all SMSF members, if you think about it. So these cases are the exception. And it's because these large balances came about because of the very generous super reforms that were introduced under the Howard government, if you remember those, Ray.
Oh, yeah. $1 million deposits, yeah. And they followed the rules.
Yeah, followed the rules at the time.
It was a boondoggle. And we know it.
Yeah, look, and they've benefited from strong markets and long-term investment growth along the way. So well done to those people. But, since then, policy changes have happened. They've significantly reduced these concessions, particularly the 1 July 2017 reforms. They've placed some strict limits on contributions. They've capped the amounts that you can put into pension
which was done by a coalition government too.
Correct.
Might add.
Correct. And look, these large balances, they're predominantly held by older Australians. And we know now, we know that death benefits have to be paid out of the system. They have to be cashed out. So it's only a matter of time that these large balances will leave the system. I think in the 10 to max 15 years, this problem will be solved. And look, super is highly complex. And this proposed Div 296 tax may add this extra layer of difficulty, introducing these new tax rates for people with higher balances. And look, I get that the system needs to be equitable and fair for everybody, but it's just pros and cons, I suppose, and you do need to factor in that the government does see that there is revenue foregone because of these generous tax concessions within super. So
but again, the upside will be, as we're seeing now, the tipping point where we're going to have more people dipping into their super rather than settling payments for the age pension, which I think was always the intention, which is great. So look, in wrapping up, do you or the IFPA see much more tinkering occurring around the super system as we go forward? Because this again was a major announcement. Do you think we're done for the medium time?
Oh, you can never be completely sure, Ray. We were told there wouldn't be any further changes to super, and then the Div 296 tax proposal was announced. So it's hard to say with confidence what might come next. Look, that said, we believe it's important for people to have confidence and stability in the super system. Fewer changes would give individuals the certainty that they need to plan for their retirement. And, knowing that the rules are unlikely to shift in the short or long term would be really helpful when it comes to planning for retirement. So short answer, I don't know. It's not possible to put hand on heart to say, this is it, Div 296 is it, no more changes, because you just never know.
Okay, we're out of time today here on Dollars and Making Sense. Natasha, always a pleasure. We run out of time so darn fast on this show because we're talking about, I think, really interesting and darn important stuff. So Natasha Panagis from the Institute of Financial Professionals, thank you again for being on Dollars and Making Sense.
Thanks, Ray. Thanks for having me on.